Good afternoon, everybody. Thank you so much for joining us today. My name is Samantha Hanson. I'm the National Sales Manager here at Pepper Money, and I'm joined by Andrew Miller.
Hi
How you going, Andrew? Can you give us a bit of an intro for yourself, please?
Yeah, sure. Thanks, Samantha. Hi, everyone. I'm Andrew. I lead the commercial credit team here at Pepper Money, specialising in commercial property finance and self-managed super fund lending. All the predecessors for Pepper that work on those commercial applications are my team that I have the pleasure of managing here at Pepper.
Beautiful. Thank you so much. And we have Ben Williams from Equifax. Over to you, Ben, if you can give us a bit of a wrap on yourself.
Sure. Hi all. So I'm Ben Williams with Equifax. I've been with Equifax for approximately 10 years on and off and working with bureaus for around 15 years, specializing in commercial area mainly and third-party data products.
Beautiful. Thank you so much, Ben. Can I just get a confirmation from yourself, Ben? Can you see the slide show up now?
I can, yes.
Beautiful. Thank you so much. So thanks for everybody for joining us today. We are focusing on near prime lending insights. So Ben is going to take us through a session on Equifax for your non-consumers. And then myself and Andrew, we're going to take you through how we can support your clients that are self-employed, whether they're a sole trader, company trust, and looking for lending for SMSF or commercial as well. So lending breadth and policy depth. Now, I guess whoever's joined us on previous webinars will get sick of me talking to this slide, but since when I was a BDM and first joined Pepper, just over 6 years ago, there was only a prime, near prime and specialist product, full doc and alt doc in the resi space. So since then, we've built out to construction in the residential space. We've also got commercial loans and SMSF loans. Now, outside of the resi product, we have a prime and a near prime option for everything, and alt doc across the board as well. So it's crazy to think how much diversification and how many new products that we've brought on in such a short time. And I know there's so many new niches and policy enhancements that we're going to be making, even coming out to the end of the year and leading into next year. So it's really exciting, and I'm really excited to see where we go with new product diversification. Now, you would have quite a good understanding, I think, now in terms of what non-bank lending is versus major bank. But to give you a summary, in terms of your major bank clients, you're looking at a typical client that might be clear credit, clean credit history, strong credit scores, and standard types of income. So when we're looking at assisting a client in the non-bank space, I guess their options really do open up. So we can assist a client who may have mortgage arrears or defaults, or maybe have been discharged bankrupt. We use lots of different income sources, and we use pretty much 100% of everything, which is really exciting. And your SLAs are really quick as well. So not only are we providing them more solutions if they've got an impacted credit report, we're taking more income, we're doing things faster, and it's a really good experience to give your clients more options. Now, before we move into Ben's session, we have just kicked off a new promo that does end on the 20th of November. So this is 25 basis points off rates for any clients that sit in that near prime and specialist home loan options. This is for the residential offering only. This does not relate to commercial and SMSF. But this is helping clients who may have an impacted credit report that do sit in those products that typically come with a higher rate due to the fact that we accept more risk. So if you do have something on your desk right now that you believe would sit into these products, then absolutely give your BDM or your RM a call. Or alternatively, if you do have a scenario, there is a survey that will come out once the webinar finishes today that does ask you a question around whether you have a scenario or not. And if you do, then later today, your BDM or your RM will be able to give you a call and run through that with you. Okay, but we're going to kick it off with Ben, and he's going to take us through Equifax Commercial. And I'm really excited to hear this session, Ben. Over to you.
Thanks, Sam. So I thought where we would start first of all was just looking at what the Equifax credit scores mean. So what we've got on screen now is our master scale. And you can see at the bottom of the page there which reports our master scale refers to. So this goes right across from our Equifax commercial apply scores, which are for individuals which are looking for a commercial loan, right through to the entities. And there's a variety of commercial entity reports there. On the right-hand side, you can see our scores range from -200 right up to 1100 or 1200 actually. And our reports report back two features. One is what is the chance of failure within the next 12 months? And the other is what is the chance of adverse within the 12 months? So two very different outcomes, but we report both on that one score, and master scale is there. So you can just look for a quick comparison of where they sit. And if I was just hazarding a guess in general, most financiers will typically look at we typically say above 500 is where they'd be looking. Some have a 600 and some run, extremely lean and might look higher than that. But for your own information, you can see that what they're looking at when they're receiving an Equifax score, and this allows you to interpret a lot better at your end as well.
Beautiful.
If for an overview, I guess,
Oops.
sorry, yeah, I was just going to quickly say whilst it was there, for an overview quickly of the difference between failure and adverse, we're just quickly looking at that. One thing I don't want to do to all of you is read verbatim off the slides, but you can see basically in entering external admin or closing down within the next 12 months. And adverse, you can see there's various points under there, but I'm sure most of you are familiar with them, mostly being around default data.
Yeah, okay.
So the first area we're going to go into is access seeker for commercials. So access seeker is quite often also known as broker access. And what we're looking at for here, the main areas we're looking at when looking at individual, and what they'll quite often do at Pepper as well, is once they run a report on the subject entity, they'll also look at the director reports as well as an individual. So they can see which other entities they may be a director of. So they can check, across the board, have they been on the board of any other entities which have gone into administration, or they might be guilty of Phoenix activity. They're just trying to cover all their bases and have a holistic picture of that individual. But the important thing to remember is when you're running an Equifax commercial apply, whether that's including the commercial and consumer data or all of the CCR data, it will not impact their score, and it does not leave an imprint on the individual's file. So that's probably the key point that you'd be getting from this slide here. And above that bottom point, we're looking at the type of data elements that you'll be looking at. So one of the key ones here when we're looking at all of the CCR information, so the comprehensive credit reporting, is we're going to be able to see that repayment history information, hardship information. It's also going to let us know not just the credit inquiry data, but who they're successful in getting those credit cards, home loans, auto loans with. So you're able to see that in a full CCR report, as opposed to just a negative-based report, which would be commercial plus consumer or commercial alone, which would just show you that inquiry data. So it's giving you a much more holistic picture of the individual you're about to engage with.
Beautiful, excellent. And so just to follow on from your point in terms of when we do a report, we do, as you said, do a report on the director as well and have a look at what other entities that the director is affiliated with. It's really important to note that we do take that activity into consideration within our loan application. So in terms of when you have a client, guys, and you're looking to do an alt doc, can you just talk us through, Andrew, when a broker submits a deal and it's an alt doc, we don't necessarily need to see the documents for all the other entities?
Yeah, that's right. Sorry, excuse me. We will look at in isolation the borrowing structure that's put forward, any related entities, any other directorships and so on that our individuals behind the borrowing structure might have. We'll observe it. The furthest we'd go is we might actually reach out to the accountant just to get a confirmation from them that those other entities are trading profitably and wouldn't be any cash flow drain or crossover into the ring-fenced application we're looking at.
Yeah.
So we don't need to see their financials. We don't need to understand their trading any further than understanding it's not going to have an impact on what we're proposing to lend them.
Yeah. So we don't need to see those documents, but we will run a credit check on all the entities that they are affiliated with and make sure that they are a fit for the product that you're applying for the client. So it's important to note that doing an upfront check on all those commercial entities can absolutely be the outcome between a yes or a no with us. So it's important to make sure you're investigating that because it will have an impact. Over to you, Ben.
Sure. So this is just an overview of what the reports look like. Now, this one specifically is an Equifax apply report. The only difference that you would see on this to an Equifax commercial apply is the wording commercial before the word apply. So we've run with the same one that we previously used. And as you can see within the report, the quick areas that you'll see is, confirming that you're working with the correct individual. So all of that PII information at the top of the report will then provide you a score. And obviously, being an access seeker, we can provide you up to 3 scores. So on this one, you can see there's a comprehensive score, there's a negative score, and there's our old Vita 1.1 score, which is there because some providers have still stayed with it, even though that's very archaic and not as maintained as it once was. And then we'll give you the summary and the headline data. So as you scroll through, probably the main areas that you're going to gravitate towards are looking at some of that repayment history information around the consumer accounts. Unfortunately, at this stage, we don't get CCR data on commercial accounts, but obviously when we're looking and dealing with individuals, having a window into their consumer lifestyle is a strong reflection of them as their commercial lifestyle as well. We find quite often that it goes hand in hand. On the next slide, we will look at a breakdown of what that means when we're looking at that repayment history information. I specifically put this in here because there's no way I remember this all on the top of my head when I'm looking at that. But so when this is being distributed online later, you can refer to the recording and you'll be able to see what each of those elements refer to. So obviously closed account would be one, and on the right-hand side is probably another key area. So what you're going to want to see on repayment history information is those zeros, which means the account's up to date. And obviously the higher the number, then it just refers to how many days beyond terms they are for those repayments, if they are at all. So that's just a quick snapshot for future reference. Now, reporting on commercial entities is quite different to reporting on the individuals. I'm just going to quickly point you to the bottom point I have on the page there, just to point out that when we run these reports, it can impact the credit score, and it leaves a footprint which is visible on the entity file. So very different to the individual, which is no impact, no footprint. When it comes to commercial entities currently, and I'll highlight that currently, it is footprint and visible on the entity file, and it could impact the credit score depending on what the velocity of previous inquiries has been on that subject entity. Why I say currently is because hopefully by mid next year, we'll be offering for the brokers specifically, the ability to look at these reports without having impact upon the score and possibly not even footprinting on the score, although they're still deciding whether that would be subject to a different area in the report, which may say this broker has made an inquiry but does not impact on the score. But currently, it can impact and does leave the footprint. Now, the type of data we get on these reports is essentially we're looking at the credit inquiry data and we're partnering that up with all the public record information data that we can as well. And of course, any adverse data we're able to collate, whether that be court actions, defaults, mercantile inquiries, summonses, writs, judgments, and so on. But probably the key one that is going to have a really strong impact is the inquiry data, because unlike individuals, we are quite restricted in what we can gain on entities at this particular stage, but in saying that, it's probably one of the key benefits of using Equifax as the provider, because we're able to ascertain with so much more data components, being the largest consumer and commercial bureau in Australia, and therefore we can do a lot more mapping around directorships and have a lot more of our own clients lodging default data and the like on here, and mercantile inquiries and so on. Now, on the second slide, this is a basic report matrix, and I've highlighted the reporter preference that Pepper like to use, which is a company scored inquiry or a business scored inquiry, depending on whether it's a company or a business. Now, you can see on the X's indicate the data elements that are being captured within these reports. Now, you can see the reports to the right-hand side capture a lot more data elements as you go along that track, but keep in mind, Pepper are running the company scored inquiry and coupling that with the Equifax commercial apply inquiries for the individuals as well, which really is equating to the in-depth company trading history report. So they're basically compiling their own from those data elements via API channels and then coming up with their own scoring mechanism off the back of that. So, but for your intents and purposes, we would be suggesting you run the same report that Pepper's running, which makes an easy like-for-like comparison when you're providing that data through to them. That's yeah.
So Ben, if they're running the company business scored inquiry report, as you mentioned, that's going to leave an inquiry, is it, on the credit
Yes,
report until mid next year? Okay.
Possibly. We've been told they're looking at around Q1 to Q2 next year when they make some alterations. But the footprint that they leave today will be on there for 2 years, just to be clear. Yeah, it won't be automatically removed. Yeah.
Yeah. Okay. I guess, well, we don't credit score for one. Obviously, it will, I guess to sort of mitigate that point for people who use Pepper, we don't credit score, which is awesome. I guess, though, any additional or unnecessary inquiries does impact the credit score as well, which is on there for 2 years. That may hinder them going elsewhere. But
yeah, we'll have visibility on the credit score, but we don't scale our decision based on the actual number itself. We will look at the inquiries, and we may need to follow up and see if that debt was actually taken out, because there might be a consideration around how it's being repaid from the cash flow we're using for our loan. But to your point, the score is there. We'll see the score, but there's no benchmark. It has to be above a certain number or below a certain number will influence the outcome.
That's right. So for us, you're covered, you're safe, you can still continue to use us. But it's great to hear, Ben, that you guys are moving towards that that option next year.
Yeah, I think it'll be a great improvement when they do that.
Absolutely.
And for the last slide, I just thought I'd provide some helpful insights around a lot of queries that come up along the way, like usually it is how long does X remain on the credit report for? I won't read them out verbatim, but happy when we open up the floor for questions if there's any queries around what's on screen. But I do think this is a very helpful slide for a lot of people, because no doubt you get queries from your own clients on, well, how long is that going to stay on my report for? What can we do about that? So depending on the duration that something has already been on there, it might actually give them some peace of mind if they know it's coming off shortly, just through natural attrition, so to say.
That's right, absolutely. And Andrew and I are just about to take everybody through the solutions that we have available to clients who do have impacts on their credit reports, such as payment defaults, ATO default, court action, serious credit infringement, repayment history information, mercantile inquiry, trade payment data. I'm not sure what trade payment data is.
If they're paying their bills.
If they're paying the bills?
I can shed some light on that one. So there's two there. So repayment history information is when you're an individual. So, and how you're paying credit cards, your mortgages, etc., from comprehensive credit reporting data. The trade payment data, Equifax actually receives the age trial balances from around 200 plus entities around Australia on a monthly basis. We take out those individual lines of trade and append them to the subject entity where appropriate, so we can provide an objective view how someone may be paying their bills as an entity. So it's very good insight, but keep in mind, depending on how many lines of trade and suppliers we have on a report, it can be, whilst it is objective, it can be subjective if there's only 2 suppliers on a particular entity in regards to how they pay that. But it's good data to have. It was initially installed to replace the old-fashioned, can you provide me 3 trade credit references we can call up?
Gotcha.
So yeah, it's a good insight.
Then one thing that's not on that page, just in terms of a consumer report, is a repayment arrangement. How long does the repayment arrangement data stay on an individual's file for?
That one I will have to check for you, Andrew.
No worries.
I could hazard a guess, but I don't want to be wrong in case it sticks in someone's mind. But I can check with my counterpart and get back to you probably before the end of the call.
In my mind, it's either 1 or 2 years. I
think it's 2.
Down. I think
for the sake of the audience, there's probably one thing that they would be interested in.
Yeah, absolutely. We can share that matrix as well in our post webinar comms email as well. Another question for me: mercantile inquiry. And I'm so glad you said that word first, because I would have totally mispronounced that. Can you talk me through what that is?
Yeah, it's basically debt collection agencies. So they're classed as mercantile agents. So debt collection agency, if they're doing inquiries on a particular entity, we would class them under a different type of inquiry, and you'd be able to see that. and it does have an impact on the score, because mercantile agents only, or debt collectors are only doing those inquiries when they've obviously been referred a debt. So it's almost like an informal default.
Yeah, got you. Beautiful. Okay, nice. That's good. Thank you.
No
Now,
problem.
what we might do, guys, because I've just changed over my laptop today, which is great. So I got tech issues with sharing my screen. So I'm going to leave questions till the end because I'll have to stop sharing. So Ben, I'll get you to hang around for us if you can.
Sure.
And then we'll do some Q&A at the end. I'm sure we'll have some time. Okay, so near prime SMSF and commercial options. So I thought it'd be great to lead on with the solutions that we can provide. And I'm going to talk you through a scenario for SMSF and then also commercial as well. And we're going to go through how they are input into the serviceability calculator as well. So we're going to touch on SMSF first, and we are specifically looking at the near prime product. Now, in terms of default treatment, we can look at unlimited defaults, judgments, and writs up to $3,000. So doesn't matter when they're registered. They can remain unpaid as well for us. Now, if you have a default that's over $3,000, it needs to be listed for a minimum of 24 months. Now, I just wanted to clarify, and I'm fairly certain I'm correct because it's the same as the Resi policy, but you can have an unlimited amount of defaults over $3,000. So we could have three $100,000 defaults, for example, just to make it quite extravagant, as long as they're registered longer than 24 months.
Yeah, that's right. And I guess just to try to unpack the difference in a self-managed super fund loan and the way we assess it, if you're relying, and we're talking PAYG customers in this example, as opposed to self-employed, but if you're looking at just the mandatory employer contributions and the rent to repay our loan, that's all coming out of their tax. It's coming out before tax. It's coming out of their pay before it becomes disposable income. So if the disposable income has had some sort of inability to meet some bills when due, that won't actually affect the income that's available to service the loan, which is why we have that bit of comfort in, whilst we know there might have been some repayment history, it shouldn't impact for those scenarios the ability to repay the loan. Got
you. Okay, perfect. In terms of mortgage arrears, that's not something that we can consider within SMSF or commercial. Have we seen any exceptions around that though, Andrew?
Good question. We're certainly open to consider exceptions to that if we can understand why there were arrears and that we're not going to have an impact on the forward-looking view. So we're looking in the rear-view mirror. There might have been some mortgage arrears. Looking out the windscreen, what's it look like moving forward? We also want to understand how they got into their arrears and that they're now through it and out the other side. I don't recall any specific scenarios recently where we've looked into that, but certainly open to considering it.
I would assume, say, for example, if it was a divorce scenario
life
and there's
events,
a life event,
absolutely.
And we can confirm that even if we can confirm that they did have capacity, they just didn't make repayments for whatever reason. If we can confirm they had capacity, they just didn't.
Yeah, for example, the money was in the account.
Or the money was in the account.
It didn't actually make its way to make the repayment, and they can show us those statements.
Yeah.
We'd be comfortable with that.
Yeah, beautiful. Excellent. So late repayments, we absolutely consider up to 3 months of non-mortgage arrears. So credit cards, car loans, personal loans, overdrafts, all of that kind of stuff. Anything that's a non-mortgage, we can accept up to 3 within the last 3 months. So just make note that when we are looking at a comprehensive credit report for an individual, we will only look at the last 3 months for non-mortgages. Anything that happens outside of that 3-month period is ignored. If they were in serious financial hardship, for example, we'd probably want to understand what happened, but it's not going to impact the product selection.
They will need to have come out of financial hardship, which is why I asked that question of Ben before, how long it stays on the file. But once they've made an amendment to that arrangement and they're out of hardship, we're right to go.
Absolutely. Bankruptcy. So we absolutely consider bankrupt clients. So just from 1 day discharge, which is awesome. Acceptable securities for your SMSF clients. So we've got residential single title. That goes up to a 90% lend. And then you've also got a 75% lend for the rest of your actual commercial security types. So we're even doing service apartments, lifestyle properties, boarding houses or rooming houses. So we can do less than 10 or over 10 for your rooming and boarding houses, and lots of other options there for you as well.
Commercial warehouses are very popular.
Commercial warehouses are very popular at the moment. Now, for a limited time only, for your Resi SMSF, we go up to a 90% LVR, and we have no lender's mortgage insurance right now. No risk fee, no LMI, no app fee. There is just no fees whatsoever, up to 90% for your Resi SMSF full doc. So that's for a limited time only. So if you have any of those in your desk, then absolutely reach out to BDM or your RM, or you can just nominate that you have a scenario in the survey and we can get one of our team to come back to you. So this SMSF scenario is going to be a near prime alt doc. The borrower type is an SMSF corporate trustee. We have a loan amount of $825,000. The security is in Garbutt in Queensland, 75% LVR because it is a commercial security type. They're in the logistics industry. They have an ABN greater than 24 months. They're looking to purchase a warehouse, interest only, 30 years with 5 years IO. And they have one unpaid default that was registered greater than 2 years ago for $18,000. So that's what's making it a near prime solution at this point. Now we've got some broker notes. So they're married. We've got a great snapshot there of the security itself. We can definitely see that it's a warehouse, factory or industrial. So the client has no dependents. We have got 2 applicants, female applicant is PAYG with a base salary of $150,000 and standard superannuation guarantee. Our male applicant is self-employed and he's a 30% shareholder and director of that self-employed entity. His latest tax return is incomplete and he also has no history of superannuation guarantee or contributions. Now that's pretty stock standard for your self-employed borrowers. They may have paid themselves a little bit of SG or they've not contributed whatsoever. In terms of credit history, we've already gone through that. So they've got the one unpaid company default, $18,000, and they have got an owner-occupied property debt of $8,000 a month. Their expenses and commitments are listed there, $7,000 a month and $20K personal credit card. And then we've got the new rental income as well for the new purchase. So let's have a look at how this translates into the serviceability calculator. So with our servicing calc, we have what we call above the line servicing, which is theoretically where a self-managed super fund services its own liabilities without any additional proposed contributions to support it. And then you have below the line servicing, which is where you can look at any surplus income from an individual perspective, and you could use that surplus income to then propose additional contributions, concessional and non-concessional. So I'm going to take you through what this looks like so you've got some visuals so you can understand more so. So we've got the SMSF name, you've got the proposed loan, interest rate and loan term. Now, above the line servicing, at this point in time, in terms of our serviceability calculator, the only contributions we have is that of the female applicant who is PAYG, and that goes under member 2. Now, it'll automatically bring through any income that has been popped into the income section. And then what we need to do is we need to allocate additional income. So if there's other SMSF income that's already within the SMSF, you would input that there. Now, what's the percentage we're looking at on other SMSF income?
If you have a set of financials for the super funds, then we'll just take the net profit because it's net of all the expenses and it's what's available at the end of the day. Mm-hmm. So you're typically talking about an established fund that might have equities or shares, maybe even a property. They've got their expenses, all washes through, so you're taking the net. If they have a cash balance or similar on the balance sheet, which I think is what you're referring to, we can apply a 4% deeming rate.
4% deeming rate. Okay. So you put your 4% deeming rate on that. And would that be the same as like say shares and stuff like that as well? We're looking at 4% on the total share?
Effectively, yes.
Yeah.
It can get a bit complicated depending on what it is and how it sits on the balance sheet, which is where the go-to easy approach is the net profit. But any liquid balances, we can assume a 4% deeming rate.
Okay, perfect. And that goes into your income on other SMSF investments. We've got our proposed net CRE rental income, which is quite straightforward. And then if this was a residential SMSF, you would put in your proposed gross residential rental income at 100%, and the cap would shade that to 80 for you. Now, in terms of your SMSF expenses, the calc will assume a default value of $1,500. However, if it is an established SMSF, you would need to go into the expenses and have a look at what that actual figure is. More than likely, it's going to be more than $1,500. So pop in the actual administration costs that's associated with that. Now, if this SMSF had other mortgages, for example, you would pop that in the other SMSF mortgages section. Now, the only bit that gets shaded or changed is the monthly repayments. So you would pop the monthly repayment in there, and then it will annualize it at 2.5% above the actual repayment, and it'll bring it into the SMSF expenses column for you.
I might just quickly explain, in commercial rent, we're talking net rent as net of the outgoings. That might not be apparent until you go through a contract of sale for an existing tenancy, but it'll always come out in the valuation, which will be a source of truth.
Yeah.
We generally apply the $1,500 as the expenses unless we see that there's a different expense being afforded through the self-managed super fund, which generally just depends on how much they're paying for their accountancy and their audit process each year. 1,500 is a general default. We're happy to use that unless we see something else.
Unless we see something else.
Yep.
Okay, perfect. Okay, so as you can see, with the income that has come through, the $16,500 for the female applicants' superannuation guarantee amount, plus the proposed net commercial rental income, there's not enough income to service this debt. So we can see we do have a fail with a DSCR of 0.54. So now what we have available and what you can use is below the line servicing. So within here, this is where you have the opportunity to pop in member 1 and member 2's complete individual financial position. So you would have the status of the members, whether they're coupled, if they've got interdependence, you would pop in there any other income. So we can see for member 1, the male applicant who is self-employed with a 30% share of his company, he is substantiating an income of 2.5 mil. I wish all of our customers had that amount of money. This is a great scenario. 2.5 mil. Now, it's really important to note any commitments for the client when you're looking at a household, it all has to go under member 1. Okay, so any commitments goes under member 1. You do not need to share that debt 50-50 or the expenses. Okay, so it all goes under member 1. And then what we have down the bottom is right down the bottom in the blue section is once you've input that information, it does provide you with an available surplus for additional voluntary concessional contributions, which is capped up to 30, and available surplus for additional voluntary non-concessional contributions, which is capped up to 120,000. Now, it's really important to note, we haven't got it on this example, but I will talk you through it. If, for example, you have a negative figure in the bottom left-hand cell, which is the non-concessional contributions. If there's a negative in there for the household, you need to ensure you deduct that negative figure off member 2's non-concessional contribution surplus and only use the difference, okay? And you would use that difference and you would then put it into the proposed non-concessional contribution section, which I'll show you shortly so you know where I'm talking about. But it's really important to note that if there is a deficit, make sure you adjust it from member 2.
And that's why we're putting all the expenses in that left-hand column, so that I'll go back a step and just break it down. So the above the line servicing, we've established ability to service based on the existing contributions and the rent from the property being acquired. If that doesn't service, then we're where we are today now on this page here. What we're trying to establish is the surplus income for the household that can then be contributed back into the super fund to make up that shortfall in servicing. And that's why we've got their incomes in the top half. The left-hand column, bottom half, is the household expenses. It's positive in this case. Away you go. You've got guidance on there we go.
Sorry, there we go. We're back.
All good. We've got line of sight on what's available to contribute back to the super fund by way of concessional and non-concessional. What's the difference between non-concessional and concessional? The tax rate. So a concessional contribution is taxed at the 15% tax rate that's afforded to self-managed super funds. That's why people like to enter these arrangements, because it's very tax effective for their retirement strategies and investing. And then any non-concessional means it's actually going to be taxed at the normal individual tax rate for that individual. What we haven't shown here, and I've got a few of these in the team looking at today, is where you've got more than 2 members. So it might be, for example, associates or friends that are a couple. You might have 4 people, and they might be 2 couples. So you then have your member 3 and 4, which you then link up the top there as being an individual couple with 3 and 4 linked, where it says that couple with. And the reason why we do that and the importance of that is that's working out what the comparison is against the benchmark living expenses for a household. That's why we also have the dependents in there.
Perfect. So you can make sure you link any associated members together when you with that status and then couple with option to make sure it's addressing how many households there are.
Yeah, the households and the default expenses for that household configuration, be it couple with no dependents, couple with a couple of dependents, or whatever variation.
Yeah, beautiful. Okay, so there's a lot going on this page, but the applicant did mention that they have not got their most recent year's tax returns, so they're going down the alt-doc path. So this is just a bit of a snippet just so you can have an understanding of what you're looking at, which figures you're going to use for the BAS calculation and so forth. So we're always looking at the most recent 2 completed quarters of BAS from the ATO BAS portal. We can't accept the pre-lodgement. And as you can see, I want to direct your eyes to the highlighted sections in yellow. So we've got the periods in this instance from January to March, April to June for this year. And then we're looking at the amount owed to ATO. So the 1A, 1B, amount owed by ATO, the G1, total sales, and if there's any W1 salaries. So you are simply then inputting the BAS figures into our BAS calculator tool, and it does all of the work for you. You will find the BAS calculator tool, as you can see on the bottom, it is one of the tabs of our serviceability calculator. So really easy to find. And then, as I said, you simply pop in the information for the 2 quarters, and it will give you an annualized net profit, an annualized income for that business. Now, our applicant did mention that he is a 30% director. He has 30% profit, and so he's allocating his income of 2.5. Now, overall assessment considering additional borrowing capacity. So in here, this is where we are inputting those proposed contributions. So I'm just going to go back 2 slides just to look at the bottom section in blue. We have 30,000 available for member 1 and member 2, and then we have 120 available for member 1 and $90,812 for member 2 in additional proposed voluntary concessional contributions and voluntary non-concessional contributions. And so what we've done is we've allocated the 30 for member 1 and 120 for member 1 under the concessional and non-concessional. We've provided the additional surplus of 13,500 to total your 30 for member 2, and then the additional 90 there for member 2 for the non-concessional. So as you can see, it's adjusted the SMSF income accordingly. Now we have plenty of income to work with, and you can see we've got a really healthy DSCR there of 3.16.
I reckon with a result like that, they'll be coming back to us for another one.
I think they will too. So that's how the above the line and below the line works. If you want further training or understanding or guidance around the calc, or you just want help inputting your first one, by all means, again, you can request assistance within the survey, okay? So we're going to move on to the commercial scenario. So again, it's the same default, it's the same treatment for adverse credit for SMSF near prime and commercial near prime, same stuff. In terms of the commercial security, so this is an SMSF commercial, this is just commercial. We have more security availability for you. So in here, you've got things like permitted residential residual stock. You've also got NDIS, high and non-high care, student accommodation, childcare centres, and so forth. So lots of options there. And the commercial scenario we're working through is a near prime full doc company borrower. And we're looking at a loan amount of $1.5 million. We have a property which is within Sydney CBD. They're looking at an 80% LVR in the medical industry. ABN and GST is over 24 months. And they're looking to purchase a medical suite. They're looking at IO repayments with a 30-year loan term. And they are a discharged bankrupt and also have non-mortgage arrears. So let's have a little bit more insight into the client through the broker notes. So we can see there we've looked at the asset type. It all looks stock standard. We can confirm it is a office or medical and consulting office. So self-employed applicant, 100% shareholder and director, and they have their most recent financials executed by their accountant. So that's what they want to rely upon. Credit history, as we can see, they have 3 months arrears on a credit card. So tick, that sits in the near prime product, and they've been discharged from bankruptcy for 3 years. So that definitely sits within the near prime product. Expenses and commitments. So living expenses are $2.5 a month. They're living rent-free with relatives. So for us, we have no notional rent. If you can get a letter from the mortgagor confirming that our applicant does not pay rent, then and it's signed and dated, you can leave that $650, that notional rent figure, out of the serviceability calculator. This client here has a business credit card worth $10,000, and then they've got new rental income for the medical suite. So let's have a look at what we need to do for a commercial client. So first things first, we want to have a look at the financials. So we're having a look here. We've got our gross profit from trading. We can look to add back 100% of depreciation. And we can also look at adding back interest as well for any liabilities that have retired. So any non-ongoing liabilities, you can add the interest back and 100% as well. And then we've got the wages here. So it's really important to note, Andrew, and you can probably clarify this a little bit more around the wages when it's not itemised.
Yeah, absolutely. So you can see here that there's 373 and a bit K on the P&L for wages. We need to understand if that is including a workforce that's employed by them, and just extrapolate out what is paid to our borrowers, the guarantors on this loan, the individuals, which we split out. There's 2 directors on 100K each.
Yeah.
That might mean we need to confirm something with the accountant, or in your investigations, the broker may have included that in your broker notes. We just need to understand if we can use all of it or split out part of it.
So would the accountant need to amend the financial statements to stipulate that, or we're happy to just receive email confirmation, for example?
Email confirmation is fine.
Of how much our applicant is actually receiving.
How much of that they're getting, yes.
Perfect, excellent. So you would obviously have a look at those financials for the most recent year. Now, step 2 is the self-employed income calc. So again, you'll find this tab in our serviceability calculator Excel. And what you'll be doing is you input and duplicate both years because it'll take the average. Now, it's just easy to pop the figures through this calculator. It means you don't have to do it yourself, and it will give you the outputs. So it'll show you how much self-employed income there is for the applicant, and then what those add backs total as well. Now, it's really important to note here, say, for example, you were working with 2 years financials. It would give you the average of the 2 years in terms of the gross profit, but it will always take the most recent year's add backs into consideration. It does not average those. So say, for example, they had a great year in depreciation in 24, but they've had they've had a smaller depreciation figure in 25, it will take 25s in isolation for your add backs. Step 3 is the actual serviceability calculator for commercial. So as you can see, and I'll talk you through it because it is a little bit small, we've got your new loan amount, which is 1.5 mil. It's got the interest rate, the loan term, the IO that was required, which is the 5 years. Now, when you're looking at a company borrower, you always need to ensure that all of their business loans are captured in the business loan section. Now, in this instance, it's just the credit card for $10,000. In terms of business income and expenses, straightforward, you're just transposing those figures from the self-employed income calc straight into the business income and add backs section. Now in here, we've got the proposed net commercial rental income as well. Then we move down to the personal income and expenses of the director. Now, as you can see here, we've already mentioned they don't have any other existing debt. They're living rent-free with relatives. They've got no kids. They're in a really great position. And they've got their declared expenses there of $2,500. So we have got a really healthy pass mark there in the DSCR of 1.54. Okay, so that's quite simple. Now, in terms of, and I'll get clarification from you here, Andrew, in terms of the personal income and expenses, say, for example, our applicant here is associated with other entities, commercial entities, and those entities have their debt. They, as a director and a shareholder, would be receiving an income from that entity. Considering that entity's liabilities would have already been taken into consideration in the expenses, where would we be putting that income? So that would that just be going in gross annual income for the other entities that they're associated with, income that we're receiving from other businesses?
Yes.
Gross annual income.
Yeah, it would. Yeah. And just sort of looping back to what we discussed earlier, if those entities are related to our borrowers but not part of this borrowing structure, we just need to understand that it's washing its own face and not drawing surplus funds from our borrowing structure to service those debts, and we can move forward with it that way.
So say for example, they didn't need to rely upon that income, we don't necessarily need to input it as well.
Correct.
Beautiful. Excellent. Okay, and so a really important note, guys, if we can't accept the security, we can't do the deal, essentially. So if you've got a client and it's not an approval in principle and they have found a security, it's really important to jump onto our broker portal, navigate to documents and tools, and then go to the commercial tools and go to the postcode calculator. Within this calculator, it gives you a drop down. So when you choose step 1, commercial, step 2, property type, it'll give you a list of all of the non-standard commercial security types. So if it's a boarding house with less than 10 rooms, for example, or a boarding house with more than 10 rooms, or it could be NDIS low care or high care, all of those specialized security types are listed in there. And once you select that, what will happen is it'll ensure that the right loan amount and the right LVR is provided, so you know exactly how much of the loan amount you can go to, and also LVR for that specific security in that specific location, because they're not all the same. So it's really important to note, use this as your first point of reference to understand what loan amount and LVR you can go to, and then go and look at your serviceability and the rate from there. But again, if you need assistance and support with understanding what the rate and solution looks like for a client, by all means, reach out to your relationship manager or your BDM, because I'm sure they would love to help you.
Can I just spend a second or two talking more about this?
Absolutely.
So, if you get a blank result at the bottom, generally it means you don't have appetite to lend there. If that doesn't make a lot of sense to you, let's say, for example, and I have seen recently newer suburbs with industrial estates, we're looking at funding commercial properties. We just haven't had the opportunity to load that new suburb into the calculator. So if it doesn't make sense, reach out to your BDM, ask, can we consider this property in this location? So that's where it doesn't make sense, because you've identified it's probably a new suburb that's not on there. When we get non-metro locations with categories outside of 1, that's when we have a bit of a restricted view on that as well. So again, reach out and ask. We are open in some circumstances to considering those properties for the right borrower. And I'm wondering if eventually we'll get rid of where we've categorised full doc and alt doc, because we actually have the same LVR appetite.
We do now.
We don't restrict the LVR because you're going a low doc pathway.
Yeah, beautiful. Okay, excellent. That is it from myself. So what I might do, I'm going to stop sharing and I'm just going to have a look at our Q&A. We have got quite a few questions here, which is exciting. Love that. So I'm going to open that up. Ben, there is some questions here for you. All right, here we go. What is the difference between Equifax Apply and Equifax Apply One Score?
One Score is for consumer only. So One Score does not exist for commercial.
Yeah, okay, perfect. How do we order these commercial reports?
That's a good question. It'll depend how you're currently set up. Usually it'll either be through either web portal or API, depending on what your current process is. If I probably knew a bit more specifically how you're currently engaging, I could probably answer that a bit more succinctly, but you'd either have your own login, or you'd be using, I'm not sure if Pepper are supplying logins. I don't believe so, but if you have your own login, that'll either be through web portal or through like white labeling through the financier.
Perfect, thank you. Yes, for everybody's knowledge, we will provide a recording of this session. We won't provide a copy of the pack itself though, because policy does change.
I was just going to quickly say, and Andrew, to answer your question from earlier, it's actually 12 months. So not 24 months for the arrears.
The arrangement.
Yeah,
okay,
the arrangement, sorry.
Hardship arrangement, that is, yes.
12 months, lovely.
12 months.
Hey team, in the credit report, where can we see the mercantile inquiries? Is this under a different heading similar to consumer and commercial inquiries?
Yes, there will be a heading if there are any, which does say mercantile inquiries.
Okay,
so only if they have had a mercantile inquiry would you see that. You won't have to decipher it separately under the general credit inquiry section.
Okay, great. How can you have judgments and writs against an SMSF since the financial accounts are audited?
I mean, it happens once a fund is established. If they run into financial trouble, it means they'll be non-compliant and we can't lend to them. Very, very rare, but it can happen. It wouldn't happen for a newly established fund that doesn't have any debt though, which I think is where that question's coming from.
Yeah, okay. The 90% no LMI promo for Resi SMSF, apologies, it is, I should have clarified that earlier, it's for prime only, not near prime. Do we factor in any liabilities outside of the SMSF? Does this change if we do below the line servicing? So I'll throw that over to you, Andrew.
Yeah, no problem. So if we're able to service just on established contributions and the new rent, then that's all we look at. We don't need to consider the other liabilities. If we're going below the line, what we're looking for there is the surplus funds available to become new contributions to the fund. So we would need to take the household position into the consideration. So yes, from an individual household perspective, when we're going below the line.
Perfect. And again, to reference below the line, I've got another question here. Do you require evidence of contributions to be injected in the SMSF prior to accepting the loan, or is it just an assumption based off their income from their company shares or equities? So if a reliance on below the line is needed and they've stipulated income that they want to utilise towards proposed contributions, we do need evidence that that income is available.
So that's what the below the line assessment does. It identifies what surplus income is available to make the contribution. I will add that in those circumstances where we are going to rely on future contributions that haven't historically been made, there is a document the clients sign to acknowledge that they will be required to make that contribution in order to service the loan and that they're comfortable doing that.
Yeah. So there's a question here on the financials. It looks like you include internet expenses or interest expenses. I think
That might be a typo.
that's a typo. It's meant to be interest. So we can add the interest back if the liability has retired. We've also got another question here. Can we do corporate trust loan with construction? What would be the LVR, SLA, and fees and charges applicable? We
Take that.
Yep.
So obviously not within a self-managed super fund. First of all, I don't
Yeah.
think this question is
I don't
a
think
self-managed
it's
super fund
SMSF
question,
related.
but you can't improve or change a property in a super fund. In a commercial property sense, if you have an inquiry, please reach out to BDM. We might be able to find a tailored, bespoke offering for that transaction. However, watch this space. We are imminently about to launch a new product which will define exactly how we go about that on a generic approach, and open it up to what our competitors are doing in that space. The product isn't available yet. It is imminent. By imminent, if not by the end of the year, very early next year, that will become publicly announced and available. In the meantime, we have been writing a few bespoke tailored loans in this space, though.
Beautiful, excellent. There you go. You got the down low. You heard it first. Also for commercial, do we factor liabilities in personal name, or are these excluded? So we do group servicing. So whatever liabilities the director has, you would have seen in the presentation in the commercial serviceability calculator that we do have a section for personal liabilities as well. Lots of questions, guys. Do all lenders use comprehensive, or do some use one score? I know we use the Equifax one score. Would you assume that probably be standard across the board now, Ben?
Well, it's two different parts for if it's a consumer, if the loan is for consumer purpose, by all means it'd be one score. If the loan is for commercial purpose, it should be the Equifax commercial apply. So I say it as such because depending on the financier, in case if Pepper's doing a consumer loan, it's going to be one score. If they're doing a commercial loan, most likely they're going to be doing an Equifax commercial apply. So that dictates where the footprint is left on that. So I know it won't matter for the brokers per se, but it can. One is a commercial scorecard, one is a consumer scorecard, and then when it gets to your financier, such as Pepper, it'll dictate where they're leaving the footprint when they do their inquiry.
Yeah.
So
Perfect.
typically I try and say match up your inquiry as the broker to what your financier, as in Pepper, are doing.
Yeah.
That way you won't have too much variation at all, if any.
Good tip. We've got one last question. So for PAYG and self-employed, what documents do we obtain from the client to determine their past contributions, and how is this figure calculated? Average of 2 years or most recent years. So we take the average of the 2 years if the most recent year is higher. If the most recent year is lower, we take that in isolation. Is that right?
Not quite.
So. No. Okay. All right.
A good way to explain that is the super guarantee has increased 0.5% from 11.5% to 12%. Just this last financial year when it changed over. So, we're not going to take 11.75% when we can take 12%. So to start at the start, to answer this question, we require for an established fund 2 years financials for the super fund. If we have that, then we'll be able to see the contributions that are made in there, and also be able to establish they've got our minimum total assets of 150K. So we'll have the line of sight on the contributions from the financials in that instance. If they haven't set up their super fund, then we would ask, assuming they have set up PAYG, they've got an industry super fund. So we'd ask for 2 years statements from the industry super fund to see those payments that have been going in historically. The most recent contributions that are being made this financial year are what we would extract from that moving forward. Additionally, we can look at pay slips. We can look at ATO income ready statements that also will show us what the historical contributions have been for that financial year, or recent pay slips, which will show that 12% contribution that's currently being used.
Beautiful. And I'll probably just add on to that. Say, for example, like our our scenario example where you've got a self-employed borrower who has got no history at all of superannuation guarantee, we'd be strictly looking at below the line servicing in that instance. So you would input the details up the top for the new loan amount and so forth. And then you could fill out below the line servicing, all the member contribution, all the members' income and expenses and liabilities and so forth. Have a look at what surplus they have available, and then pop that into proposed concessional and non-concessional. Now, it's important to note that our minimum asset balance, which can be made up of cash, equity, or shares, is 150,000, which is the total value of your concessional and non-concessional caps of 30 and 120. So if you've got somebody that has no history, they will meet the total minimum asset balance for us if they have the cash available to put towards the purchase. And then we can just look at proposed concessional and non-concessional contributions to service that new loan within the new SMSF. So lots of options and really flexible around that. One more question here. Are minimum assets required post-settlement? No, we have no liquidity test. So you can use all of your 150 for the purchase. I think me personally, I probably would advise to have a bit of liquidity, having an SMSF set up myself, but we don't require any liquidity.
Yeah. But we want our customers to be set up to succeed, bearing in mind, this is a retirement strategy investment. So the one thing I will just add on there as a qualifier is if we know they're purchasing a property that doesn't have a tenant in place, so it's vacant, we'd have a look at what the reasonable vacancy period or let-up time is. Let's say on average you're looking generally out there in a resi market of 3 months. If they had more than 3 months worth of repayments left over as residual cash in their fund, we'd be pretty happy with that scenario.
Yeah.
So it's not a requirement, it's just a sanity check. Will they run into trouble if the property is vacant and they don't have any cash left in their super fund? It may mean they make additional repayments on a concessional or non-concessional basis as well, but we get a lot of comfort when there is a bit of cash left over.
Yeah, but I think all in all, we're very flexible to provide a solution.
Absolutely, that's the word, flexible.
Flexible. All right, that wraps it up. Thank you so much, Ben. I really appreciate you jumping on today. I'm sure you've added immense value to everybody who was on the call today. I definitely learnt a lot, which is awesome. Thank you, Andrew, as always, for joining me. Just remember, guys, there is a survey that will come up on your screen after I close out the webinar today. Please answer it for us. It's going to enable us to assist you if you have a scenario, if you want to become accredited for a different product, and allow us to better support you moving forward. So thank you once again. Have a lovely afternoon, and bye for now. See you later.